If you have a stocks portfolio, are a buy-to-let landlord or a homeowner, then the coronavirus's impact on the property market could rock your finances. On the residential property side, the ban on viewing properties and moving home because of the coronavirus pandemic has brought the housing market to a grinding halt.
Commercial properties are looking no better. In the form of REITs, these are at the core in many of our portfolios, either by buying shares directly in REITs or concealed within popular indices that we buy, such as the S&P 500. With the vast majority of the UK's office staff now working from home and the high street set to be a ghost town, by the end of 2020, empty department stores and office blocks will be the new norm. People have proved that they can just as easily shop online and work remotely from home.
The impact on the property market and on our portfolios could be huge. While the government has now eased these rules, allowing the housing market to start up again and some workers to go back to the office, predictions for property prices are grim.
In this video, we'll look at how what is happening in the property markets will impact your portfolio, both rentals and stocks, and whether we would due a market crash around about now anyway. Let's check it out. Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. Is a property crash on its way? Shutting down the economy has caused a huge reduction in what people are spending. Except on toilet paper, obviously. With some figures showing that the lockdown has shrunk the economy by 31%. It's also forecast that UK residential property will fall by as much as 13% by the end of 2020. People's incomes are shaky or non-existent.
Commercial property and REITs set to crash too. A real estate investment trust, or REIT, usually holds commercial property and can be thought of as a property share. They trade like a stock, and many of our portfolios include them, whether you know it or not. 3% of the value of the S&P 500 is from REITs. It doesn't sound like a great deal, but if they collapsed, you'd feel it.
Many, like us, invest directly into REITs to gain exposure to this key sector. So much of the world's wealth is tied up in commercial property, but it would be silly not to. If you're looking to invest in REIT ETFs, then you get a great range of choice on premium investment platforms like Interactive Investor. There is a monthly fee, but their investment range is unparalleled compared to the free investment apps. We'll put a link to this in the description below. If you do use this link, it helps support the channel at no additional cost to yourself, so thanks to those who do.
Commercial property is actually up since the crash, following a similar path as the rest of the stock market. This is the iShares developed Markets Property Yield ETF and is entirely invested in commercial real estate from around the world.
The rental sector will be hit hard. We think the private rental sector could be the catalyst of an impending housing crash. Those most at risk of unemployment tend to be young people living in rented accommodation. If they lose their jobs and can't afford to pay their rent, then this could have a knock-on effect, with landlords having to sell up and flood in the market.
But fast recovery for residential prices, your home and rentals. A mixture of furlough and low interest rates should help limit house price falls, with estate agent Knight Frank expecting a quick boom back to normal prices in 2021 once pent-up demand is released.
Could be great for stocks. For years, companies have been questioning the need to spend millions and millions on city centre offices and retail space.
Well, now they've been forced to find out the hard way. Staff can work from home for most, if not all, of the week, and people not bought into the concept of online shopping before can now see the benefits of it.
There is no need for companies to spend millions on commercial rent anymore. Pretty much all of the companies we own shares in spend a fortune on office space. The money saved could be in the hands of shareholders via dividends.
Is commercial's future foobarred? Obviously, this same set of circumstances would be disastrous for the shareholders of the commercial property that is no longer desired, or at least unable to command such high rents anymore. As we've seen, commercial property REIT investments are still flying high, too high in our view.
Sell, sell, sell! We think the prices of some REITs will plummet once companies start allowing their leases to expire. Normally, we never sell investments other than to rebalance our portfolios, preferring to hold onto assets indefinitely so we can one day live off the dividends.
However, commercial office buildings and retail space look like dead ducks to us. We personally cannot imagine both working and shopping practices going back to normal anytime soon after all this is over. They will surely lose some value. Sell, sell, sell!
The 18-year property cycle. If you're still unsure whether there will be a property crash, you need to know that a property crash was being predicted even before the coronavirus started. The property cycle is typically an 18-year period of time that repeats over and over again, in which historically the property market has moved in a more or less predictable fashion.
Phase 1, the recession phase, typically lasts 4 years, and during this time property prices plummet. In 2008, the subprime mortgage crisis started the Great Recession, and property prices fell off a cliff edge, losing 16% of their value in that year alone.
Phase 2, the recovery phase, typically lasts 5 years. If the property market was keeping to the script, the recovery phase would have run from 2012 to 2016. However, with such a deep and prolonged recession in 2008, the property market continued to recover until the start of 2020.
At this point, we are long overdue a correction, and this leads us into Phase 3. Phase 3, the mini crash, comes midway through the cycle. It is a relatively short 1 to 2 year period of time where the markets get nervous about prices rising for so long, and any sudden event can trigger a market correction or mini crash. We think that the economic jitters caused by the coronavirus is very likely to trigger this natural part of the property cycle.
Normally, a mini crash is a great time to buy property and property-based investments because prices are down but credit lines are still crucially open.
Phase 4 is what we can expect to come once the world gets over its current issues. The boom phase is on average 7 years long, which brings us to an 18-year total. The stretched out recovery phase of the current cycle might mean that the next boom phase might be shorter, but who really knows?
Key takeaways. What we take from this is that a property crash was coming anyway, and now is almost certainly confirmed. We, like other commentators, think the rental market will be squeezed, but will bounce back strong.
There's not much you can do about office and retail REITs when they're embedded into your regional ETFs. A crash may even work to the benefit of other companies in the index if they're not having to pay out such high rents anymore. Those savings will likely be passed on to us shareholders. But you can at least reassess the office and retail REITs that you've been buying directly if you are as worried as we are about this once great sector.
Question of the day: are you worried about commercial or rental property prices? Let us know in the comments below.
Thanks for watching. On this channel we talk all about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.